Welcome back for Class 2.0. In our last 5 classes, we've discussed all things investing, including the basics of stocks, bonds, and all kinds of funds. We also distinguished between 2 basic types of accounts we may use to invest. These are retirement investment accounts and brokerage accounts. Beginning in this class, we'll be taking a deep dive into how these accounts work and what types there are of each. Let's begin. A retirement investment account is an account specifically designed to fund a person's life when they are retired. Sometimes these accounts are referred to as retirement savings accounts or retirement savings plans. Since individuals are primarily investing through these accounts, I will use the term retirement investment accounts. Individuals who aren't in business for themselves, that is, they work for an employer, can participate in a retirement investment account only if that employer offers one. While many employers offer employees the ability to participate in their retirement plan, not all do, and some employers only offer this to some employees. For example, salaried positions with benefits. The most common retirement investment accounts offered by employers are 401k plans, 403b plans, 457 plans, and the Thrift Savings Plan, or TSP. The primary difference is what entities can offer these plans. For-profit entities such as corporations, partnerships, and sole proprietorships can offer 401k plans. Certain nonprofit entities such as churches, public schools, and other 501c3 tax-exempt entities can offer 403b plans to their employees. State and local governments and other 501c3 tax-exempt organizations can offer 457 plans to their employees. And finally, the U.S. federal government offers their own retirement investment plan called the Thrift Savings Plan, or TSP. Going forward, we will use the term traditional in reference to these plans. Later, we will also learn the term Roth, and we'll explain how those plans are different from traditional plans. Okay, great. So if I'm an employee of one of those entities, and if they offer me a plan that I qualify for, I can participate. But what if I'm self-employed with no employees? Well, for self-employed individuals who have no employees, they can typically create and participate in something called a solo 401k plan. The owner and potentially their spouse or domestic partner can contribute to this type of plan. These plans are sometimes referred to as solo participant 401k plans, solo K plans, uni K plans, or one participant K plans. Okay, let's get back to how the investing part works and what the benefits are. Traditional plans such as 401ks, 403bs, 457s, and the TSP allow for the employee to have a percentage or a set amount deducted from their pre-tax earnings on a regular or even a one-time basis. The amount taken out of their pre-tax earnings and contributed to their retirement investment accounts is called the employee's elective deferral amount. What does elective deferral even mean? Traditional plans allow employees to contribute pre-tax earnings and defer the taxes on this contribution until the money is withdrawn. For example, let's assume my earnings were $75,000 per year, paid twice a month. $75,000 divided by 24 pays equals bi-monthly earnings of $3,125. Let's assume I elect to contribute 5% of my earnings to the traditional 401k that my employer offers. My employer will deduct about $156 every pay from my pre-tax earnings of $3,125. And that deducted amount will be contributed to my 401k investment account. This money will then be invested based on the investment preferences set for my account. I will have the power to determine how my money will be invested based on the availability of investment options offered by the plan. We covered what investments are typically offered in our last few classes. In traditional plans, in addition to your contributions being tax deferred, any investment income, including dividends, interest, and capital gains on those contributions, as well as any contributions your employer makes on your behalf, also called matching contributions, will be tax deferred until the money is withdrawn from the plan. Let's discuss those matching contributions. Some employers will contribute an additional amount into your retirement account in addition to the amount you contribute. For example, let's say my employer will match up to 4% of my earnings for the amount I contribute. Using our last example, I contributed 5%, and my employer will deposit an additional 4% into my account for a total of 9% contributed. This is a form of compensation, and if you are able to, it is very smart to at least contribute the percentage that your employer is matching. Otherwise, you are leaving money on the table. For instance, instead of contributing 5%, let's say I only contributed 1%. My employer would only match the 1%, and I wouldn't receive the other 3%. While your contributions stay yours, your employer's contribution match to your account may be subject to vesting rules. Vesting generally refers to a length of employment an employee must meet for the employer's contributions to vest or become theirs. For instance, an employer may require that an employee remain employed with the company for at least 3 years for their matching contributions to vest. Otherwise, the employee will forfeit the rights to that money. Some employers have a tiered vesting structure. For example, an employer may allow matching contributions to vest 25% per year worked, and some don't require any vesting. It's important to understand the vesting rules when you are hired, so you know if you may be leaving money on the table if you leave your job too early. It's also important to note that you aren't limited by the match percentage and can contribute more if you'd like. There are, however, limits that the IRS places annually on the amount you can contribute. This is typically referred to as the Employee Basic Elective Deferral Limit. For 2024, this limit is $23,000. Normally, your employer will not allow you to contribute to a traditional plan once this limit is reached. However, in some cases, it will be up to you to manage. For instance, if you switch jobs during the year. It's very important that you don't over-contribute to your traditional plan, because if this doesn't get corrected timely, you may be charged tax on the excess contributions when made and when you withdraw them in retirement. That is, you could be taxed twice on the money. If you do over-contribute, it's important to contact your employer and/or the retirement plan provider to have those excess contributions returned to your employer and taxed as earnings for you prior to April 15th of the year following the excess deferral. In addition to the basic elective deferral, which is limited to $23,000, individuals who turn age 50 or older during the year can defer an additional amount of $7,500 into their traditional retirement accounts for 2024. This amount is called a catch-up contribution. Also, there are limits to how much your employer can contribute in matching contributions in a given year. For 2024, the combined employer and employee contribution limit is $69,000 per employer. This amount excludes the $7,500 catch-up contribution, bringing the total allowable employer and employee contributions per employer to $76,500 for the year. These amounts are typically updated annually. It's important to understand that these limits aren't separately applied to traditional retirement investment accounts and Roth retirement investment accounts. The limits apply broadly to any contribution to either type of retirement investment account. Okay, let's shift now to discuss withdrawals from a traditional retirement investment account. Generally speaking, as of the date of this video, if you make withdrawals from your retirement investment account before you reach the age of 59 and a half, you will be charged an additional 10% penalty tax on top of the income taxes you'd normally be charged on the withdrawal. The IRS refers to these as early withdrawals. There are a number of exceptions that can exempt you from paying the additional 10% penalty tax. Some notable exceptions include allowing for a withdrawal of up to $5,000 per child for qualified birth or adoption expenses, up to $10,000 for qualified first-time home buyers, qualified higher education expenses, and many others. You can find the list through the IRS's website, irs.gov. For me, I view making early withdrawals from my retirement accounts to pay for non-retirement expenses a last resort. It's important to keep this in mind so you don't put yourself in a tough situation down the road when you might not have enough funds to retire when you'd like to. The early withdrawal penalty isn't the only thing you need to be aware of in terms of withdrawals. There is also something called a required minimum distribution, or RMD. An RMD is a minimum distribution an individual must take in a given year. The RMD rules are quite complex, but generally speaking, those with traditional retirement investment accounts must take RMDs in the year they reach age 73. The RMD rules change, and the calculation takes some work, but I just want you to be aware that they exist and the age when RMDs are required can change. Some plans even allow participants to take a loan on the money they have invested in the plan. Loans are typically tax-free, but incur interest that the participant must pay. In addition, individuals won't be able to earn investment income on that money during the term of the loan. Again, I view these as a last resort. That's quite a bit of information on traditional retirement investment accounts. So let's stop here, and I will continue the discussion in class number 21 with Roth retirement investment accounts. We'll also cover individual retirement accounts, or IRAs, including both the traditional and the Roth variety. In future classes, I also plan to cover defined contribution pension plans, defined benefit pension plans, and also how Social Security works. We'll also discuss the decision to invest through either a Roth versus a traditional retirement investment plan, and other important concepts. I'm looking forward to helping you learn more. If you have any questions at all, I encourage you to contact me at opusmonetequestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. If you found this content to be helpful, I'd like to invite you to hit the subscribe button and give us a like. You can find additional resources, insights, and motivation by following us on Instagram and TikTok. Also, we greatly appreciate your recommendations. If you think this content may help your friends and family, share the wealth and let them know about us. See you all in class number 21. Peace!